Taxation during the Commonwealth period. During the Commonwealth period, new policies and laws were introduced to make the taxing system more fair. In 1936, income tax rates were raised, introducing a surtax on individual net incomes above 10,000 pesos. The Sadala tax was eliminated in 1937, which seems to be a progressive decision. However, every individual above the age of 18 and every corporation had a house in 1940. The Commonwealth government created the National Internal Revenue Code in 1939, which made significant adjustment to the new tax structure. The normal tax of 3% and the surtax on income was replaced by a single tax at a progressive rate. Number 2, the personal exception were reduced, so it means that everyone is really need to pay the tax. 3, corporation income tax was slightly increased by introducing taxes on inherited estates or gifts donated in the name of the dead persons. So even you will inherit, or even if it's a gift for dead person, it does really have a tax. And number 4, the cumulative sales tax was replaced by a single turnover tax of 10% luxuries. And number 5, taxes on liquors, cigarettes, forestry products, and mining were increased. So anything that it has this is really have increased on tax. And lastly, number 6, dividends were made taxable. The introduced tax structure was an improvement of the earlier system introduced by the Americans, but still remained inequitable. The lower class still felt the bulk of the burden of taxation, while the upper class, the landed elite, or the people in political positions were able to maneuver the situation that would benefit them more. The agricultural sector was still taxed low to promote growth, but there was no incentive for industrial investment to take root and development. Finally, a common character of taxation during the American occupation in the Philippines was not used to diversity, the economy, or direct economic development, as some sectors still carried the disproportionate share of the tax burden. As World War II reached the Philippine shores, economic activity was put to a stop and the Philippines bowed to a new set of administrators, the Japanese. The Japanese military administration in the Philippines during World War II immediately continued the system of tax collection introduced during the Commonwealth, but exempted the articles belonging to the Japanese armed forces. Foreign trade felt the main source of taxation came from amusements, manufacturers, professions, and business license. As the war raged, tax collection was difficult task and additional incomes of the government were derived from the sales of the national sweepstakes and sale of government bonds. The expenditure of the Japanese military government grew greatly, and they issued military notes in order to cover the cost of the war.
Fiscal policy from 1946 to present. The war's impact on the Philippine economy was effectively desperate, as the capital Manila was razed to the ground while the rest of the country escaped relatively unharmed. The heavily agricultural-based economy was shattered. By 1949, many aspects of governance such as the military and education sectors were severely underfunded. The impetus for economic growth came during the time of President Elpidio Quirino, through the implementations of import and exchange controls that led to import substitution development. New tax measures were also passed, which includes new higher corporate tax rates that increase government revenues. Tax revenue in 1953 increased twofold compared to 1948. Post-war Philippine fiscal policy remained regressive, characterized by the overburdening of the lowest classes, while the landed elite who held businesses' interests were in Congress to ensure that taxes would not be levied to them. From 1959 to 1968, Congress did not pass any tax legislation despite important changes in the economy and the vested interests of Filipino businessmen in Congress. Indirect taxation still contributed to 3/4 of tax revenues to the Omnibus Tax Law of 1969, did not increase the ratio of income tax to generate tax revenues. Under Marcos Regain, taxes grew at an average annual rate of 15% and generated a low tax yield. During the later part of Marcos' years, 1981 to 1985, the tax system was still heavily dependent on indirect taxes, which made up to 70% of total tax collection in gross domestic product, and predictable taxable capacity was at a low 10.7%. As Corazon Aquino took over the government following the EDSA revolution, and she reformed the tax system with the 1986 Tax Reform Program. The goal was to improve the tax system's responsiveness, promote equity by ensuring that similarly situated individuals and firms bear the same tax burden, promote growth by withdrawing or modifying taxes that reduce incentives to work or produce, and improve tax administration by simplifying the tax system and encouraging tax compliance. The introduction of the value-added tax or VAT was a major reform in the tax system introduced during Aquino's time in power, with the following features. First is uniform rate of 10% on sale of domestic and imported goods and services and 0% on exports and foreign currency denominated sales, and so on. The VAT legislation was signed in 1986 and went into effect in 1988. While it was a reliable source of revenue for the government, new tax laws would reduce its reliability as the number of legislated exemptions increased. Tax collection and tax audits were intensified, computerization was introduced, and corruption was relatively reduced, which improved the trust in the BIR in general. As a result of the tax reform of Aquino's administration, both tax and revenue effort rose, increasing from 10.7% in 1985 to 15.4% in 1992. Greater political stability during the administration of Fidel Ramos in 1992 allowed for continued economic growth. The Ramos administration ventured into its own tax reform program. This was to make the tax system broad-based, simple, and with reasonable tax rates, minimize tax avoidance allowed by existing flaws and loopholes in the system, encourage payments by increasing tax exemption levels, lowering the highest tax rates, and simplifying procedure, and rationalize the grant of tax incentives. It was estimated to be worth 531.7 billion pesos in 1994. The VAT base was also expanded to include service in 1997 by Republic Act 7716. The following were the improvements and exemptions to the VAT law. Vice President Gloria Macapagal Arroyo's second term saw increased government spending without adjusting tax collections. This resulted in a large deficits from 2002 to 2004. The government had to look for additional sources of revenue, and in 2005, the expanded value-added tax or EVAT was signed into law. The EVAT base expanded from energy products to include coal and petroleum products and electricity generation, transmission, and distribution. When President Benigno Aquino III took office in 2010, he promised that no new taxes would be imposed and that any additional revenue would have to come from adjusting and existing taxes. The administration experimented with adjusting and the excise tax on liquor and cigarettes, also known as sin tax reform, for fiscal, public health, and social order reasons. Republic Act 10351 was passed, increasing government revenue from excise taxes on alcohol and tobacco. Tobacco and alcohol tax collections accounted from 1.1% of GDP in 2015, and the improvement in tax collection resulted in Philippines receiving investment-grade credit rating. The sin tax reform was an example of how tax reform could impact social services because it allowed for an increase in the Department of Health budget. The administration of new President Rodrigo Duterte promised tax reform, particularly in the area of income taxes, with the goal of lowering income tax rates paid by working Filipinos. The country's current income tax scheme is the second highest in Southeast Asia, and the current income tax laws are outdated, having been drafted 2 decades ago. The proposed tax reform would also limit VAT exemptions and raise excise taxes on petroleum and automobiles. It is hoped that changes in the country's tax policy will result in much needed economic development felt even by the poorest member of society.